Welcome to the CoWaCo. Remember, like, subscribe, comment, and share. And let you all know we're not financial advisors. This is for educational purpose only. And we about to get it in. All right, you all? All right. So first, we're going to start off talking about how to fit investing into your budget. Chris, what you got to say?
Yes, sir. Yes, sir. Ladies and gentlemen, thank you for tuning in to the company water cooler. That is Leroy. I am Chris. We appreciate you for joining us. So, alluding to a few videos, because we're going to keep talking about this. We talked about this before. How do you manage money, right? So Leroy brought up the excellent point last time around about budgeting. This is what it takes for you to start investing your money. So you have to decide of your money that you have to pay. And I put that in quotes because so rent or mortgage, right? Utilities, you got to keep the lights on. Water, you got to keep the water running. You're going to obligate yourself for your car payment or your insurance on that. Hopefully your car is paid off and your insurance is only $50 a month and you don't have to worry about that $300-400 expense that comes from the car payments every month. But that's a fixed expense as well for 6 to 7 years, right? Sometimes longer. But outside of the money that you have to spend, everything else fluctuates. Groceries is going to fluctuate every month unless you budget and you say, this is where I'm going to stop, that I'm not going to go over that point. Your cell phone bill, it's going to go up and down by a couple cents, so you can put that in there. But we have emails, so you don't absolutely have to have a cell phone. But I mean, with the way that we live our lives now, we'll go ahead and consider that a fixed expense, right? So that's $100 a month. And then you have everything else in terms of maintenance on your vehicle, even maintenance of your phone. When you have to get another one, you crack the screen, you got to go get it fixed. I recommend just buying the screen off of Amazon and learning how to fix it from YouTube yourself. It's a lot easier. The whole tool set and just get the tool set, get the screen, fix it, watch that YouTube video, put it together, you're good. It's going to take some time, but it's worth it. Trust me, you don't have to pay somebody $200-300 to fix your phone. But all of these other expenses, though, they fluctuate, they vary, right? So groceries is one, gas for your car is another. If you drive an electric vehicle, charging that is another flexible cost. Maintenance, of course, is going to be flexible as well because you don't need an oil change every month, right? You don't need your transmission fluid swapped every month. You don't need brake fluid every month. If you do, please consider getting another vehicle. But these things fluctuate, right? So every 3 months, you'll get an oil change. And every 75,000 miles, you'll swap out every 15,000 miles, you'll swap out the transmission fluid. Every 25,000, every 75, whatever, right? All of these things are flexible expenses. Take your fixed expenses, things that are not going to change for the foreseeable future, right? Calculate how much in a year that costs. All of this in the backdrop of you totaling what your net income for the year is. So if after taxes and everything is paid, Medicare, Social Security, federal tax, state tax, all the other taxes, you make $40,000 a year. If your fixed expenses is $1,500 a month, let's say. Well, let's say your fixed expenses are $2,000 a month, right? That's $24,000 a year, okay? And you make $50,000 a year. So you know that 27 or 26 of your 50,000 is money that you have to spend on clothing and laundry and grocery and various other things, right? So your $2,000 a month covers all of your expenses. That covers rent, that covers car, that covers insurance, that covers life insurance. Definitely make sure you have that. That covers phone bill, that covers water, that covers utilities, that covers everything. $2,000 a month, all your bills are good. You got $26,000 for the rest of the year, okay? This is, unfortunately, most people will spend that eating out, going on vacation, right? I cannot remember her name, but it was a doctor. I want to say her last name, I want to say her name was Washington, Dr. Washington, but she said, a lot of people think when they go on vacation, they just going on vacation. But you're not going on vacation, the vacation is going on you. Because you're gonna have to work overtime when you come back. You're gonna have to work 10, 15, 20 hours extra a week for another 5 or 6 weeks just to make up for that vacation that you took for 4 or 5 days, right? So she is a proponent of making your vacations business expenses because you have a business, you have that card, use that for that. I'm going here to scout locations, I'm going here for business meetings. So that way, that's not money, that's not a liability. It becomes an asset for your business. Investing has to be a part of that. You could even say, I'm gonna set 10% aside a year, and I'm gonna break that down by the month that I'm going to invest. I'm gonna invest 5% of my total salary every year into the market. I'm going to invest 2%. I'm going to invest 20%, whatever it is, and then you break that down by month. So let's say you want to invest 10% of your $50,000 every year. Okay, that's $5,000 that you want to invest for the whole year. It doesn't seem like a lot, right? But you take that 5,000 and you say, I'm going to divide that every month, and every month I'm going to invest. What is that? 5,000 divided by 12, or 5,000 divided by 12 should be 600, because 600 would be 7,200 a year. 500 will be 6,000 a year. So 450, I believe. Anywhere between, I think it's between 4 and 500.
So 5,000 what?
You're 5,000 divided by 12.
Divided by 12.
It should be 450.
5,000 divided by 12, about 417, something like that.
470. Okay. So if you decide you're just gonna round that up to 420, right? So you're gonna take $420 a month, and you're gonna invest that. You could divide that by the week, right? So you can invest now. What is that? $105 a week. So now you could take $105 a week. You could divide that by the day. Okay. Well, I'm gonna invest $14, $15 a day, however it is. But if you want to do it every pay period, if you want to do it every month, it doesn't matter, right? Let's say you want to do it every pay period where you take $210 every pay period and you invest it. Make that a part of your budget and make that the first payment that you make, right? The smartest thing to do is when you get paid, the first thing you do is pay yourself. Because if you're a W-2 employee, you've already paid how many institutions already? Right? I just told you Medicare, Medicaid, Social Security, federal, state. That's 5 already that you paid. You paid 5 people before you paid yourself. So make yourself the 6th man. Come off the bench strong. Okay, cool. 210 is going to me, and I'll put that over here in the market. This is how you decide. This is how you budget your money. I like to work in percent. I like to work in. Okay, well, if I have 50,000, 100,000, 200,000, whatever, I got $500,000. I'm going to take 5% of that, 10% of that. And then I'm going to break it down by month, break it down by weekly, break it down by week, and say, okay, well, if I've got 500,000 a year that I want to invest 10% of $50,000, I am going to, now that's $4,000, right? Now that's 4,000 some change a month. Okay, that's 1,000 plus a week, right? Because it's 52 weeks in a year. I want to invest $50,000 a year. I'm just going to say, let me just invest $1,000 a week. If that's easier for me to do, that's easier for me to do. Okay, cool, boom. Then that's invested, right? But I made that a part of my budget, and that's the first thing. So then all of those other fluctuating expenses, I have to be smart, and I have to maneuver. Okay, well, if I'm investing $1,000 a week or if I'm investing $500 a week, $100 a week, $20 a week, I'm gonna spend less on gas. So what am I doing now? I'm putting more towards my assets and I'm shaving off my liabilities, right? If I know that I can carpool to work with somebody that lives 10 minutes down the street from me, and all I got to do is give her $20 a week in gas, well, I spend $40 a week in gas, so I'm saving half my money right there. Now, if I need to go somewhere else outside of that, go to the grocery store, whatever, more than likely I'll use my car. But if I'm giving her $20 a week to go back and forth to work, I don't think she'll have a problem one day out of that week stopping at the grocery store and letting me in there for an hour. That's one less thing that I have to do. Then I can start budgeting smaller for my grocery bill, right? Now this depends on, how many people are being fed. This depends on your taste. I'm not gonna take your taste away from you. I happen to have a bougie palate myself. So it's some things that I'm not gonna sacrifice. You know what I mean? It's something because I don't have to. So it's certain things that will be in my pantry, certain things that will be in my refrigerator, right? That's just, and I can't knock you for that. But if your flexible cost pool that you're dipping from shrinks, you have to move that money around. And this is my choice, right? So if you want, I'm never going to recommend you spend more on liabilities. I'm going to recommend that you find better ways to fund those, right? So you find out what your tax money is going towards and utilize those services that has that, right? If you can get 30% off of a spare room in your house because you claim it as an office, put a computer in there, a desk and a chair, that's 30%. That's an office, right? And use it for the purpose that you say you're using it for. That's 30% that you save on your taxes, right? Because that's where your businesses run out of. Boom, that's 30%. That's 30% more that you have to put in assets. So you have to be smart. So find these different avenues of, okay, well, if my pool of liability is here, this is where I'm going to keep it. And eventually I'm going to shrink that, or I'm going to turn some of those into assets, or those are going to be business expenses. So this is how you figure out how you're going to incorporate investing in your budget. Know what your fixed expenses are. Know what your flexible expenses are. Shrink your flexible, and if possible, shrink your fixed. Just cut them at a lower rate. Shrink your flexible, right? Because your investing budget, the one that you put right here in front of you, you want to expand that so that it consumes both. And now all of these are being run out of your assets. So you got fixed, you got flexible, you got investment. You want your investment to be your biggest.
All right. So I also want to mention too, and Chris actually mentioned this in the last video too, about letting that automatically come out of your check. So like whenever you actually get paid, right? If you automatically set it up, you won't even be thinking about it. So it automatically just whoop, swoop, and then you'll be thinking, oh, okay, this is what I usually get paid. And then eventually, that money that you actually have, you automatically, that went into there, and you can be able to actually invest it into, again, solid companies. So you'll keep saying that. And then I think he was saying with the M1 Finance, you can actually have it invested in certain stocks also too. So you can automatically just have it go straight to it, we're not even, thinking about it.
Set yourself up for that success. Get you 4 or 5 good companies in a portfolio and just auto set your money. Like, so you put M1. So okay, you got Apple, you got Microsoft, you got Tesla, you got Amazon. I didn't say Amazon, you got Amazon. And then let's say you want to put yourself a dividend stock in there. So you put Coca-Cola in there. You have those 5 companies. If M1 is going to get $200 every other week or $200 a month from you, as long as that direct deposit keeps coming in, that's money that's going in. And then you say, hey, reinvest all my dividends. You'll be surprised, you look back a year, how big that portfolio is. right? Because that's $2,400 principal after the year, right? That's $2,400 already invested. But that does not account for company growth. That does not account for DRIP, right? The dividend reinvestment plan. That doesn't account for them. So at the end of the year, when you look at that, you're gonna go, oh yeah. I like this. This is good. And you keep that going for 2 years, and then 3 years, or 4 years, 5 years, it'll be unrecognized. People are like, man, this account is 6 digits. What? My principal is only like 20,000. This is crazy, right? Automate it. What you have to, so automate success. That's what you want to do. You want to automate success.
Automate success. And I also want to mention too, when Chris also said about setting up like that room, or even if he's an apartment, like a certain area, for a business, think about maybe some side hustles that you actually can get, and basically by you actually doing these side hustles can also be your investment money, that you actually can use to be able to invest, some of that, just to kind of with that money that you're actually making from your particular, main job. And I consider, a side hustle is still like a job also too. And also, even if you're a business, that side hustle, you can actually write that off as a business, and then you can add in like that, 30% he was talking about with that particular area that you actually use for your particular side hustle, and that'll even help reduce your expenses whenever it comes doing tax time, where you might can get a little bit more maybe back on your taxes. That then you can also use that to invest also too.
Right.
So I just want to mention that also too.
Yeah, that's important. So, and that 30% figure, that was as of 2020, and I'm speaking for North Carolinians here. If you're listening from another state, you have to look up your own, but that 30% applies to you using a designated area inside of your home or apartment or living area, as long as it's, obviously they have qualifications for it. But that 30% you can take off of your mortgage or your rent every month if you're using that space for this. And they have a few parameters that you have to abide by, and you get that every month. But here's what you don't do. You don't get, that's a 30%. When you deal with taxes, all of the money has to be paid up front, and then you get your money back later, right? So you have to, with taxes, you have to keep your receipts. So if I'm a small business owner, and let's say my business makes $20 million a year, I have deductibles, right? I have employee salaries, wages, and I have health insurance that I'm covering for my employees. I have investments. I have all of these different things that I can deduct. This is how Amazon pays $0 of taxes, right? They find other ways to spend their money on a consistent basis. So every year I'm going and I'm spending $1 million on backpacks and crayons, right? This is my good deed for the year. So every May, June, and July, you're gonna see my truck, my big truck pull up, and all we buying is we just handing out crayons and book bags and sneakers, whatever, you know what I mean? We handing out pencils and paper for all the kids, right? And we might even do a little raffle for some iPods, some iPads, or, you know what I mean? Some Apple products, right? Which is gonna further my other investment. But I do that, I pull up, all right, kids, hit your bags, moms and dads everywhere, happy, yay, we love them both. That's $1 million that I can say, hey, I didn't make that money technically because I spent that on the community. But you keep that receipt. You keep that receipt. So that 30%, that's where I got that. And that might actually apply nationwide because that was a federal, I do not believe that was specific to North Carolina, because I think you might get an additional percent on top. So one thing to remember about taxes, they're federal taxes and they're state taxes. So a good example is electric vehicles. There's a $7,500 credit for the purchase of electric vehicles in the country. So no matter what state you live in, if you report that to the federal government that you bought an electric vehicle, they'll give you $7,500. Not before you buy the car. You're not gonna get that before you buy the car. You gotta buy the car first. Then they say, okay, cool, he bought the car. Here's 75. It's a rebate, right? Taxes is just rebates. So your state might say, okay, well, in addition to, right? Or they have their own. So whatever state you live in, they might say, okay, we're offering $5,000. We're offering $5,000 for you to purchase an electric vehicle. So that's $12,500 from Samuel and from your state to buy an electric vehicle. So if you can find an electric vehicle for, I don't know, $30,000, right? And you pay that money up front, you'll be getting $12,500 back. So you would have only spent, what is that, $17,500 on a vehicle, right? Like a brand new electric vehicle. But it's a rebate. So that those tax, you got to look up the tax codes in your country. Federal applies everywhere, obviously, it's federal. But then you have to look specific to your state. And then you want to look to your county. Then you want to look to your town or your city. Your mayor might say, hey, well, the county offers $1,000 for EVs. We here in whatever city or whatever town, we're going to offer, and we're going to match that $1,000. So now from your county and from your town, that's $2,000. Let's say your state says $5,000, federal says $7,500. That's $14,500. Just hypothetical here, right? But find out what programs your city, your town has, your county has for business. The one thing that your town and your city are not going to do is turn away business. They're not going to do that. They're just not going to do it. So they're going to find a way to make the environments better for business owners. They need businessmen and women to come in with ideas to say, I have this, I want to put it here. Fantastic. Here's what we can offer you. And there's your tax break.
All right, you all. All right, so next, we're going to talk about, can I wait too long to invest? Chris, what's up? What's up, Chris?
Well, no, that's the answer. All right, next point. So, I mean, with that, I mean, really, because a lot of people think, most people that are not invested think that they waited too long. Oh man, it's too late for me to invest in Amazon, man. Amazon, they done got up to $3,500, man, and they done split, and it's too late for me to invest. Man, Google done got up to 3,000, it's too late for me to invest. Man, Tesla done got up to 5, man, it's too late for me to invest. Do you think these companies are gonna stop growing? That's the first question that you have to ask yourself. And do you think these companies are gonna be here in 10 years, 15 years, 20 years? If the answer to that first part is yes, I think these companies are gonna stop growing, then no, don't put your money in there. If the answer to the first part is, nah, I think these companies are gonna keep growing, and the answer to the second part is it still too late, or, you know, are they offering me anything? You have to ask yourself, when it comes to investing, ask the 10+ year self, ask yourself 10 years later, about 10 years back. So look at yourself now. Let's say you're 20 years old now. Think about investing from your 30-year-old self, right? Man, if you would have invested when you was 20, you would have got that. Think about your 30-year-old self from 40-year-old self. Think about your 40-year-old self from 50-year-old self. What are you going to find? You're going to find it's always the right time to invest. Because if you're 50 years old and you haven't purposefully invested yet, and you look at your 60-year-old self and say, where could we be? Perfect time to invest. 70 to your 60, 80 to your 70, right? Whatever. Yes, the answer to the question is, you can wait too long to invest if you never invest. Yes, right? Because then you never invested, so you absolutely waited too long, right? But if it's something that's on your mind, it's something right here, right? It's in your frontal lobe, right here with your third eye. It's that frontal lobe, right? It's in your pineal gland. Put it into play, right? You cannot wait too long. Yes, you could buy at a high, right? Apple was at like $190 in January, right? It's at 150 something now. Do you think it's gonna get back up to 180? Absolutely, right? So if you bought it at 180 in January, now's the best time to buy because it's not 180, but it's sure gonna get back up there, and you'll make up that difference, right? Your dollar cost average down. So you can wait too long to invest if you never invest, absolutely. But if always is the right time to get into the market, always, because it's a learning experience, right? It's never going to be you getting into the market and not learning anything. No, you're going to get in, the market's going to drop a couple points. Man, I knew I should have got invested, man. I just lost 5%. No. You don't lose anything until you sell at less than what you bought it for. So if you buy something for $200 and it drops down to $195 in value, you wait for it to get above $200 so you can sell it at a profit. That's all you have to do. If you have a lot of patience and you haven't invested, I don't know that those people exist. I don't know that it's a guy out there that is extremely patient and hasn't invested. I don't know that it's a woman out there that's extremely patient and hasn't invested, because investing takes patience. It really does. A little bit of focus and a whole lot of patience. You do that and you're set. So yes, you can wait too long to invest if you never do it. At any point before that, it's never a wrong time to invest. Always is the right time to invest. Every day, every week, every 2 weeks, every 3 weeks, every month, every 6 months, every year. It's always the right time to invest.
That's what's up. Now, think of it like this too. Like a person that says about starting a business, right? Or a person that wants to get into business and never actually take the step to actually start the business.
Right.
Same concept with the investing.
Right.
Look, this start. He said that you're going to have some bumps in the road. It's okay. You can also learn through the process. Man, look, you got the CoWaCo in the building right now, and some other videos before that's constantly educating. Take a look. Take a look. We pouring out the information for you all. And then you just take an extra step, even if you Google things, if you actually decide to actually even get into groups to help you along the way. Like, come on, you got people out here like, come on, get in the group. So look, we're gonna help you. We're gonna do it together by building, setting yourself around people, make yourself feel comfortable to invest. Even if you're taking a class, get yourself comfortable. Just do it. Invest.
Yeah, that's a good idea too, Leroy, with the groups. And I know you mentioned that before, but you get into groups of people. And listen, these don't have to be 1,000, 2,000 people groups. You don't even have to do that, right? You can do, listen, call your best friend, call your cousin, right? Your brothers and sisters. Hey, look, I want to do this investing thing and I don't want to do it by myself. Can y'all do it with me? That doesn't take away from any dignity that you have. That's actually a very noble thing to do. And over here we are the noblest, but it doesn't take away from anything. If you say, hey, mom, dad, look, I know that y'all don't know a whole bunch about money because y'all generation won't talk that. I know that y'all, y'all didn't have or whatever, or y'all had this going on, that going on. But look, I want to do this over here. Every month I'm gonna put $100 in that bucket over there. Can you match that? And this is what I'm gonna do with that $100 that we put in the bucket. This is what I'm gonna do with that $50 that we put in the bucket, that $20 that we put in the bucket. I'm gonna put it over here. Be extremely transparent. When it comes to somebody's money, be extremely transparent. Please don't. Yeah. If you take somebody's money, let them know what you're doing with it. And you know who to ask for money and who not to ask for money. So be mindful. Okay, be mindful, because if I know that I can't get $5 from you, without you asking me where that $5 at the next time you see me, I'm probably not going to invite you into my investing group. But if I know that I can trust you and I know that you're good with money and you're good with finances, hey, let me just get this 50 a week from you real quick. This is what I'm gonna do with it. I'm gonna put it over here. Boom, boom, boom. Now, if it's a lot of trust in there, you can even say, hey, give me the $50. I'll put it in my account and invest it on our behalf. And if anything goes south, you get the money back. I mean, that's a lot of trust. I really only recommend that for family. But even if you say, hey, we're just gonna put this money in a savings account to start. Every week you put 50 in, every week I put 50 in. And after 6 months, you say, okay, well, we've got this amount of money, man. We got a couple thousand. Hey, now we're putting our money into the market, man. And all of the money from the savings account, we're going to connect it to our brokerage account. These are the companies that we're purchasing, and we're going to automate it. You could do that, but you could do that in a group. And it's a really good way to start. You could even start by going to your family, going to your friends, going to your loved ones, going to those that are close and saying, hey, y'all, let's raise $5,000. Let's put $10,000 together. And they say, well, why you do that? Well, I mean, I got an idea and I think it might work, right? I think it might work. No, we're going to do this I'm doing this for the rest of the year, right? So let's say you start in February. You start in Black History Month. You want to end on Christmas. All right, so we're going to start in Black History Month. We're going to go to Christmas. I want to raise $10,000 between all of these people, right? Let's say September comes and you get that $10,000. You call a meeting. Hey, everybody, so y'all all have invested. Here's the presentation. Here's the plan for the $10,000. You can get out now if you want, and you can keep your money with me. Now, they've forgotten about money, right? All of the ones that gave you the money before, back in February, back in March, back in April, they forgot. It's going to be the ones that gave you the money last week, or the ones that gave you the money at the end of July, beginning of August. Hey, cuz, they might be the ones you got to worry about. But they're going to be outnumbered by everybody who put their money in before. So they're going to be, I don't want to say sequestered, but they're going to be hushed into, hey, he's giving a presentation. Let's see what that man has to say. And so they're going to say, all right, well, look, I gave you the money because I had the money to give it to you. Do what you got to do with it. Now, you can take that $10,000, go buy some land. You can take that $10,000, start a business, but wholesale, buy some stuff and sell it individually, whatever the case, and then redistribute that profit back to the family if you want to. But that's how you culminate. That's how you get people to come, hey, no, look, think about it. I just want to raise $1,000. I want to put this into an account over here. That's going to be the family investment account. And then I'm going to grow that account from there. But I need $50 a week from each one of y'all, $20 a week. You start informally, and then you get something down contractual. Then you open up an account and you have direct deposits pulled from the account every month. $50 every month, right? Imagine if you got 10 family members on that, right? So that group thing that you said, Leroy, I like that idea, because being in a good group, because there's some groups out there that are not so good, but what being in a good group does, it allows you to hold yourself and everyone else in the group accountable. And accountability is motivational for a lot of people. So I appreciate that group idea.
Hey, man. Well, look, we feed each other, learn off of each other. So, yeah, man. So, look, favorites for the week. Let's get it.
Yes, sir. Yes, sir. So this week is gonna be the fourth and final. Yes, this is the last dividend pick of my portfolio before I get back to Apple, Amazon, Tesla, Home Depot, Walmart, UPS, before I get back to them. So this is my last dividend pick. It's my fourth dividend pick that I'm gonna give y'all for my ideal dividend yielding portfolio. 3M. That's M. Okay, company's been around forever. They've been giving dividends for well over 50 years. I want to say they've been giving, they're dividend aristocrats. I believe they've been giving dividends now 64, 65 years. But dividends for 100, they've been giving dividends since they existed. But 3M, this is the industrial, consumer discretionary, like they fit under so many categories. This company they give a good payout, like 4.5% dividend payout. They have a payout ratio of close to 70%, which is high, right? Because that means that they're taking more than half of the net income. Remember, this is all the money after expenses, and they're giving it back to shareholders. Now, 3M has been here, it's going to be here, and they want that consecutive dividend growth. So this is why that payout ratio is kind of you have to kind of be cautious because they want to consistently and consecutively keep growing the company. But investors like myself that have a good view on the company, we're going to keep investing in the company. So yes, that dividend payout ratio is high, but my and I know fellow investors' sentiment is good. So we believe in the company, we invest in the company, we're going to keep the company going. So that payout ratio is okay with us because they've been giving dividends for decades now, and they're not going to stop. And a dividend increase of 0.01 cent is still a dividend increase. So 3M is my company for the week. Dividend payout ratio 67%. Like I said, close to 70. 4.5% dividend yield, and they do pay quarterly.
Okay. All right, I'm gonna go with syntax. It's spelled CINTAS. And it's a company that when you go into like these office buildings, they have like a first aid kit in there. And also they rent out like uniforms to corporations. Also too. So if you think about it, corporations and companies have started kind of opening back up, where they have employees coming back, into work, but they still have, like they don't come in every day. Some basically allow you to, they have certain days where people still, people come in, but they're definitely having people come in. So those are starting getting used again. And also with the uniforms, their uniform store, also too. I'm sorry, they sell uniforms to corporations. So again, it's the CINTAS. And I'm gonna do Dollar General in there too. You'll be surprised how much Dollar General stock exactly is. So when you take a look and see how much that stock is, you're gonna be like, what? Did he just say Dollar General? Yeah. I just said Dollar General.
Dollar General is a good company, man. Yeah.
So those are the two that I'm picking for this week right here.
Yeah. So, and look out for the fresh food offerings for Dollar General too. It should be, because I know we mentioned those before. This actually might have been like the second or third video, but we're YouTube famous. But that look out for the fresh food from Dollar General. If they can get if they can get that, man, if they can get just a small produce section, they'll be Yeah, they'll be good. They're already good now with the triple leases, but if they can get that fresh food section of the store and it actually look like something, and people want to go in and they don't have to go down the street to the market to get oranges, apples, pears, Dollar General's gonna be set.
All right, you all. That's it. The CoWaCo, the company water cooler. Like, subscribe, share, comment. All right. Peace.
We'll see y'all next week.